Welcome, economic students, to another virtual learning lesson, Macroeconomics, Chapter 15 of the McConnell book. This particular lesson introduces students to the principles and concepts related to the beginning of this chapter, and that is how banks and thrifts create money. So, we're going to go over this story called The Goldsmith, and the Goldsmith story is important because it highlights some incredibly valuable economic principles and concepts. The first lesson of the story is the transformation from commodity money to commodity backed money, paper currency backed by physical commodity. And then we'll talk about the invention of, importance of, the fractional reserve banking system and why and how the fractional reserve banking system makes money creation possible. We'll go through the process of money creation when loans are granted, and actually money destruction when loans are repaid, and we'll tie that into the idea of reserve or reserve requirements of banks. Finally, we'll talk about the idea of bank panics and the need for regulation. All right, the anecdote of the goldsmith and the 10 merchants. So imagine a time when gold was used as money. Gold was money because it performed the three functions of money: medium of exchange, unit of account, store of value. Now, assume the merchants traded wares. They traveled back and forth trading goods. They used gold as the money. Assume for the moment that there were 10 merchants and each merchant possessed 100 gold shekels or gold coins, which brings us to a total supply of money of 1 million, right? 1 million gold coins. Now, there's a problem with using gold as your money, right? First is that it's cumbersome. If you're thinking about carrying gold coins with you everywhere you travel as a merchant, it takes up space, it's heavy, it's cumbersome. An even more pressing challenge with using gold as your money supply is the idea that not everybody in the world is honest, individual up to nefarious activities. You're vulnerable to be robbed. So the fact that gold is cumbersome and you could be robbed by a thief made these merchants seek out a better or different system. So that's where the goldsmith comes in. Right? Assume that each of the 10 merchants takes their 100,000 gold coins and deposit their gold coins with the goldsmith. The goldsmith issues each merchant a receipt for each coin. So now each merchant is holding 100,000 receipts, one receipt per one gold coin. We have now discovered or revealed our first important lesson from this anecdote. Society changed from commodity money, the gold coins, to commodity-backed money, the paper currency, the receipts. The receipts represent gold that can be redeemed at any time in the future with the goldsmith. Important idea there, right? Now, what's the next important idea? Well, let's assume that the new system works so well, the goldsmith hardly ever hears from the merchants. The merchants are so content using these paper receipts as a medium of exchange that they hardly ever come back to see the goldsmith. Goldsmith's actually kind of getting bored. Maybe every once in a while they'll stop in and say, hey, I just want to see, make sure my gold's still here. But the goldsmith rarely sees the merchants. A citizen of the town strolls in to see the goldsmith and says, hey, we have a lot of these merchants that travel through our town selling their wares, wouldn't it be nice if we could make some money off of them? And the goldsmith agrees with the local citizen, and the local citizen says, wouldn't it be great if we had a general store? In the general store, we could sell goods that the merchants might be interested in purchasing since they're staying in our town. And the goldsmith listens to the man's proposal, and the citizen outlines a business plan, and the goldsmith is thinking, man, this is a great idea. You should build that general store. And then the citizen says, well, I'm glad you like my idea, but I don't have the money to make it happen. You're the goldsmith. How about you give me a loan? So now the goldsmith's thinking, wow, every member of the economic community accepts the gold receipts as money. They're as good as money because they facilitate exchange. So the goldsmith gets an idea, said, I can print up 100,000 receipts, grant a loan to this local citizen interested in building the store, and I can collect interest on the loan. So when that happens, two important ideas occur. Number one, the money supply has expanded. When the goldsmith grants a loan, which is equivalent to the bank of today, right? Money is created. Money is created. Now, what does that mean? Money is created. Money is created because the goldsmith creates $100,000 of money that was not previously in the system by granting the loan. So the money supply increases from 1 million to 1,100,000 or 1.1 million. So first idea is that when a loan is created, money is created. Expansion of the money supply. The second, and probably more important idea, the invention of what's called the fractional reserve banking system. Prior to the loan, we had a 1-for-1 ratio between gold receipts and gold stored with the goldsmith. Now we have only a fraction of gold in the vault of the goldsmith relative to the receipts. That's a pretty high fraction, right? But there's only 1 million shekels of gold or piece of gold. There's 1.1 million receipts. So the money supply was 1 million. The money supply increases from 1 million to 1,100,000 when the goldsmith grants a loan to the local citizen interested in building a general store. Fractional reserve system has been invented. This is the basis for modern day banking, and the important economic principle which explains how modern day banking actually creates money by granting loans. Just as important as understanding the process of money creation through the loan process is the idea of and the lessons associated with money destruction when loans are repaid. So let's say Joe Q. citizen who borrowed 100,000 in receipts from local Goldie Goldsmith does really well with his general store, and 2 years after taking the loan hands the goldsmith 100,000 receipts that the goldsmith allowed him to borrow. Informs the goldsmith, thank you very much for the loan. I did well. It was a great idea. I'm repaying the loan. When that happens, money is actually destroyed. Now think of it in these terms. The money supply in the economy is no longer 1.1 million. It's no longer 1,100,000 gold receipts. It's just 1 million gold receipts. So we're back down to the original relationship. Now, of course, at that point, we are no longer operating on a fractional reserve. There's $1 or one receipt paper currency in circulation for every piece of gold deposited with the goldsmith. Prior to regulation and what we now know as FDIC, Federal Deposit Insurance Corporation, there was always a possibility of a bank panic or a run on a bank. Banks needed to be prudent lenders. Banks needed to balance the potential income associated with making loans and the revenue of collecting interest with the possibility of many customers showing up at their bank simultaneously and demanding to withdraw their funds. Some of you may have seen It's a Wonderful Life, that scene with Jimmy Stewart, explaining, well, your money's here and your money's there, and how the banking system works. Even if banks, prior to FDIC, were prudent lenders, there was still a possibility of a bank run when citizens of a certain geographic region or area were worried about this possibility of not getting their money. So, to eliminate that issue, all banks pay into Federal Deposit Insurance. FDIC, Federal Deposit Insurance Corporation, insures all depositors that up to and including $250,000 deposited into a bank will now be guaranteed. So if the bank goes belly up, it doesn't matter. It might take a week, might take 10 days. You will get your funds because all banks pay into the insurance system. Now, an interesting thing to discuss, especially at this point in U.S. economic history, is the idea of the reserve requirements in the United States. So, banks are regulated by our nation's central bank, the Federal Reserve. So the thousands of banks that are owned and operate in the good old US of A must adhere to the laws that are put in place by our nation's central bank, the Federal Reserve. The Federal Reserve has a required reserve ratio, which means if a bank takes in a certain number of deposits from its customers, not all of those funds are permitted to be loaned out. Some of it has to be required reserves. So, in 1992, the reserve requirement, the required reserve ratio, was 12%. So if a bank took in $100 million from depositors, from its customers, it was allowed to loan out 88%, in this case 88 million, and it had to keep 12%, 12 million on reserve, either in their bank vaults or with the Federal Reserve. That ratio was lowered in 1992 to 10%. The nice thing about it being 10%, it's easy to do the math in your head. Forever, the reserve requirement remained at 10%. And most economists believe the Federal Reserve would never change the required reserve ratio. In a later video, we will talk about an idea called the money multiplier and how the money multiplier is derived from the current reserve ratio. It is April 18th, 2020. We are in the midst of the COVID-19 pandemic. The Federal Reserve is using every tool at its disposal to prop up the economy. Economic fallout from coronavirus is going to be enormous. One of the changes the Fed made recently meaning a few weeks ago, the Fed lowered the reserve ratio to 0, meaning that banks can lend out all of their deposits. It is nearly impossible for me to describe, number one, my utter surprise at this happening, and number two, what will be the repercussions 1, 2, 5, 10 years down the road. And that's what's interesting about teaching economics. Literally, nobody knows what the repercussions will be because we've never tried this before. But in a later video, when we talk about the system that was in place for years, the required reserve, and how the required reserve ratio affected the money multiplier, we will investigate this new Fed policy to a higher degree. Quick review of what we learned in this video. Using the story of, or the anecdote of the goldsmith, we introduced a few important economic principles and concepts. The first principle or concept that we discussed was the transformation from commodity money, gold coins, to commodity-backed money. The receipts, aka the paper currency, each of which represented a gold coin. Today, we've transferred even further. We use fiat currency. As we learned in the previous chapter, the money in circulation in all countries today is not backed by any physical commodity. The next thing we talked about was the idea of money creation and money destruction through the fractional reserve banking system. The example of the goldsmith and the merchants, $1 million in receipts backed by $1 million in gold coins, 100% reserve. Fractional reserve, when the goldsmith decided to grant a loan, there was only a fraction of gold coins in the vault relative to the paper receipts in circulation, fractional reserve system, which allows banks to manipulate the money supply. When a loan is granted, when a loan is created, money is created. In the example we used from this particular story, the money creation process introduced $100,000 into the banking system. When the loan was repaid, $100,000 was destroyed or taken out of the banking system. We talked about the idea of the Federal Reserve setting a reserve requirement in the modern banking system and the recent news of what happened with this particular tool of monetary policy, the required reserve ratio. We talked about bank panics and regulation and the FDIC. One important final point, the required reserve ratio was never meant to be a backstop. It was never meant to prevent bank panics. Even when the required reserve ratio was 12% or 10%, it was never going to provide banks with the instant liquidity necessary to meet all withdrawal demands if all customers showed up at one time. FDIC, the Federal Deposit Insurance Corporation, is the reason why we do not have to deal with bank panics today, because citizens of the country are quite certain that their money, up to and including $250,000, is guaranteed because of the insurance program. Later, next few videos, we will investigate monetary policy in more detail, and we will discuss the history of monetary policy, the traditional tools of monetary policy, and the Federal Reserve's role as lender of last resort during this pandemic and how it expanded its role in assisting the economy.